Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining us. I'm your host, Lance Pederson. This is the Real Estate Risk Report. So today, our guest is John Casmon with Casmon Capital Group. How you doing, John?
Hey, I'm doing great, Lance. Thank you for having me on today.
No, the pleasure's all mine, man. Thanks for joining us. So before we kind of jump into it, just a bit of an overview, and I'll let John sort of introduce himself and share where he's coming from. But John and his team, they're based in Cincinnati, Ohio. They're sort of serve as operators, multifamily deals of their own, kind of in their backyard. They also, will partner up and kind of serve as, co-GPs with other sponsors, in the Southeast and other areas, which is sort of a trend that, we're seeing more and more, which makes a lot of sense. The analogy I always, that I think is clever, maybe others don't, but it's just sort of the notion of, it'd be like, running a trucking company and have to also own your own, fuel refinery. Not many people would probably do that, right? It's like they want to just go to the gas station and fill up the trucks and, deliver things from point A to point B. In real estate, it's sort of, you've got to have them both, right? You've got to be able to go out and find deals and find them and underwrite them and acquire them. But then you also have to, go and make your own fuel. You've got to find your own capital, and it's sort of a different thing. And it's a ton of work, especially when real estate is, the beauty of it is that it's an inefficient market for the most part, especially commercial real estate. And, fragmentation's a feature, right? It's everywhere, and it's hard for anyone to sort of, dominate, and maybe Amazon will prove us wrong and figure out how to, corner it too. But, it's probably not going to happen. So anyway, we're going to look to John to sort of, pick his brain here and share with, kind of how they evaluate deals, but maybe just give us a little bit of background on how you got into real estate and, the types of deals you're doing and why you formed Casmon Capital and those things.
Yeah, absolutely. Well, first of all, thank you for having me on the show. My background is in marketing. So professional corporate background was in marketing. I worked for large companies, big agencies, delivering huge campaigns, multi-million-dollar campaigns. At one point, I was working at General Motors, and I was there from 2007 to 2011. For those of you listening, you can recall that was around the time we had our big financial crisis. And I will tell you that just taught me a lot about just, the corporate life. And, I was in a great position. I was a young executive. And ultimately, the day we had some layoffs, I remember looking at my phone out of voicemail that day when I went in, and there was a guy who sat in front of me, and he basically lost his job, and he was really distraught. He had no idea how he was going to, cover his bills. He was supposed to get a pension. He had worked there for 22 years. And I just it was just really clear to me that day that while I was very empathetic for him and what he was going through, I never wanted to be in that position. So I started to find ways to invest on the side, ended up building that up into a small $1.5 million personal portfolio. But I was using all of my own funds to buy deals. And I started to learn how other people were growing and expanding, and really starting to think, how can I actually serve other people as opposed to just doing deals for myself? Got introduced to, working with other people, working with investors. Still had no clue what syndication was, by the way, but going through that process, learning more about working with other people, that's when I started to see like, oh, okay, you can pull resources together to go out and acquire deals. And the next deal we ended up doing was actually 192 units. So much larger than I would have anticipated. But because we're working together as a team, the options really just opened up. So right now, our business model is twofold. We find and manage our own deals where we're vertically integrated. So those are going to be more deals that are close to us in the Midwest. So think about Columbus, Indianapolis, Cincinnati, Louisville, Kansas City. Those are kind of the markets where, we are seeking opportunities. But we also continue to partner with other operators because, like you said about, your fuel and refinery trucking company analogy, for us, if we try to say, hey, we're looking for a deal anywhere in America, there's no way we can be efficient. Even the markets I just named to you, it's hard for us to find every opportunity across 4 or 5 different markets. So we have to pick 1 or 2 to go deep in and then expand to opportunities as they present themselves. But if we can partner with other operators in different markets, that allows us to see more deals, evaluate more opportunities, and cherry pick the best ones for the investor network that we've been able to amass. And because with my marketing background and just the connections we have, we always bring those services to any deal as well, making sure we understand the market dynamics, doing all of our market research, understanding the business plan, the projections, and our investors really trust us to do a lot of that vetting on their behalf before we present an opportunity. Ultimately, it's up to an investor to decide to move forward with an investment. But they know if we've brought them an opportunity, we've already done a lot of that analysis in regards to the market, the partnerships, the operators, and making sure we are bringing really good opportunities to the table.
Yeah, exactly. So in terms of like some of your home markets, which one, which market are you sort of more fond of the, Cincinnati and Louisville and Columbus? And so like, if we were going to pick one to sort of drill into and go deep, and I think on your podcast, don't you do a lot of sort of market-based content?
Yeah, we do. We started off with the show really being about markets. I mean, the show's called Target Market Insights, and we launched really with the intent of finding the best places to invest. And what ended up happening is, you do these shows, and after a while, you kind of have done a lot of episodes where you can almost kind of predict the show. So I wanted to keep it fresh. So we've expanded from just focusing on market research to now talking about marketing holistically. But to answer your question, Cincinnati is probably the market that I live here, and we're fully integrated here. So we go pretty deep into this. But maybe we can ladder up your question, because I think part of it is like, as an investor, what are the things you should be looking for in the market, and I can answer that question.
No, that'd be great. Yeah, I think that I like that market specific stuff. I mean, like we talked about. I mean, fragmentation's a feature. It's market driven. You buy something on one side of the tracks versus the other side of the tracks. Like it has there's some truth to it, right? So why don't since you've really spent a lot of time in markets and I try to touch on it obviously to sort of not everyone's been everywhere, and certainly it's just helpful to kind of get that, but yeah, why don't we kind of talk about how you look at assessing a market?
Yeah, so there's the macro and the sub-market, right? So on the macro market level, part of what we're looking for is really just understanding where a market is headed. And those are going to be things like population. Is this a growing population? Is it stagnant, or is it declining? Excuse me. We're going to be looking at the industries. Is the industry, are the industries diverse? Are there multiple employers there? Is it a diverse employment base? Or is there really one industry that's driving it? So you tend to think about Detroit, where I lived and worked, being focused on the automotive industry. You think about Vegas being focused on tourism. So in an industry or a market like that, there's some concerns there. I'm not saying you shouldn't invest there, but there's a red flag there, because if something happens to that major industry, the entire city, the entire metro can be impacted, even if the other industries are fine. And we saw that in 2009 with the automotive industry, the impact it had on the city of Detroit, and how Detroit was impacted at a greater rate than other cities and other markets because of that. So that's something as an investor we certainly want to avoid if at all possible. So we're looking at the population growth, we're looking at the industry diversification. Then I'm also looking at the ease of doing business, right? Is this a place where there's regulations, they're promoting growth, business growth? Are there grants? Like, what's actually happening from a political standpoint? Are they encouraging growth, and are there active plans to drive that growth? Or are they making it pretty hard with all their regulations to launch a new business, or encouraging new employers to create a new office or warehouse in that city? So what is the market actually doing to foster growth from an employment standpoint? So those are some of the things we're looking at. And I guess going hand in hand that we're looking at employment growth itself. So are new jobs being added to a market? Is it stagnant, or are jobs leaving that environment? That gives us a pretty good sense of what's happening holistically. And then more specific to multifamily, I want to know about construction. What's going on with supply? Are there new units, new apartment complexes that are being constructed, or is it stagnant? And there's not necessarily a right or wrong answer. We are simply trying to understand, hey, is supply meeting demand? Or is supply outpacing demand? Is there a lot of new construction, but demand is maybe lagging that new construction? Because in that case, what you can expect is rents to either fall stagnant themselves, or they may pull back, where maybe you now have to offer concessions or things like that to get those apartments filled up. And that tends to go downstream, right? If I can get a brand new Class A apartment building for, let's just say $2,000, and you were hoping to get $1,700 for a 40-year-old apartment building. Well, I mean, that gap right there is too close, right? So I may be willing to pay a few $100s more. And by the way, if that $2,000 unit has to offer concessions to give 1 month free rent, now that's even closer, right? So they're going to fill those because they're the cream of the crop, right? They're brand new construction. They're new, and they've got all the bells and whistles. So the market is set really by the top end, and everyone else falls in line after that. So if they actually don't meet their numbers and they're not able to pull rents up higher, then the rest of the market is going to get reset lower. So if you have a business plan and you're expecting to increase rents $200, you better understand what's happening with supply and demand, because if the supply is outpacing demand, then you may not be able to implement your business plan. So in some cases, we're actually looking for places where it might be a little hard to do new construction. So it's not always a great sign that, hey, there's all these new apartments being built. Sometimes that could be a red flag too. So,
yeah, that makes sense. So since, like I said, you've done a bunch of these markets. Is there a market right now that maybe others, no one else is really talking about that you're kind of bullish on, that's sort of the overlooked market that you think has got, a lot of potential?
Yeah. When I launched my show, I was concerned that no one would want to answer this question, right? Because they're like, I don't want to tell you the markets I'm focusing in on. Sure. But I was surprised that people were pretty open and honest with it. So there's a few resources that people can look at. Marcus and Millichap does a report every year where they list out kind of their expectations and their market projections. It comes out right around this time. So I haven't seen it yet, but I would expect it to come out within the next week or two. So by the time your audience is listening to this, you can go to the Marcus and Millichap website and go into their multifamily report section, and it should have kind of the 2021 multifamily market projections report available. Another one is IRR. The IRR viewpoint. They do an analysis every year as well. So I always like to pay attention to those things, like what are they seeing at the macro level? What impact is being taken place, and all those kind of things. The markets I like here, I'm always focusing on places where there's really good cash flow, there's appreciation potential, but there's not as much demand as some of the more popular markets. Yeah. So right now, Indianapolis was one of those markets. It has creeped up as far as the demand goes, and we've been outbid on multiple deals in that market. So while we love that market, we love it at the right price. Sure. So we're not gonna just buy into it because we like it. We are focusing a little bit more on Northern Kentucky, Louisville, Kentucky, and the Kansas City market as well. We really like that region of the country. I would say Northern Tennessee too, but we like that region of the country just because you can get really good cash flow. It's seeing good growth or solid growth in most of those markets, and you're not seeing quite as much competition. There's still good demand for those markets, but it's not what we're seeing in some of these other markets where maybe the prices are being a bit inflated, or there's more cap rate compression. So for us, if we can buy for really solid cash flow today, we believe that mitigates our risk. If we have a great cash flowing asset that has some upside potential, that's the way we like to invest. I know a lot of other people are buying properties where maybe the cash flow is light right now, but they're hoping that in the future, the appreciation is there and they can sell it, at a gain at that point. I just think where we're at in the market, we feel more comfortable buying something that we control when we exit. And that's really driven by the cash flow. If it's making money today and we're able to deliver strong returns to our investors today based off of the current operations, not speculating on the future growth, that puts us in a strong position to deliver for our clients versus buying an asset where we really only can hit the return metrics once we sell. That way we're not forced to sell. We can hold off. If the market swings in the other direction, we're not in a position where we have to exit right away or, anything like that. We can hold the asset, and that puts us in a bit more of a power position.
Yeah. So post-acquisition for you guys, I mean, what are some of the, what are the top things that you do? I mean, given that you have a marketing background, kind of curious if you leverage some of this, and since you are vertically integrated in your local markets, means you're managing the properties and leasing them up and stuff like that. But are there other little things you do that maybe others don't necessarily do, once you guys get a hold of a property to, I mean, obviously cutting expenses and, increasing revenues and, those things are what people are after. But are there like more specific things that you guys tend to do once you take over a property to kind of put yourselves in position to execute your plan? I'm just curious as to kind of what are your top 2, 3, 5 things or whatnot.
I think the very first thing is understanding the business plan, right? So I come from corporate America where we oversaw $1 million campaigns, right? And a lot of those campaigns really started with understanding what we were trying to get accomplished. So the marketing was just, the last piece to it. It really laddered up to the business plan. And in this case, what we like to do is understand what is our business plan? What is our strategy? And then we can get into the tactics. So all of that's done in advance. Like we're not putting in an offer on a property without clearly understanding the business plan and our strategy. Yeah. So once we take over, now we can implement the specific tactics based on the strategy that we've put in place. So let's use an example. Let's say we want to buy I'm just going to say a 200 unit apartment complex. It's a B-class property, and we believe that there's an opportunity to make some renovations and get the property closer to like a B++ or A- kind of quality property, where it's just underneath, those newer construction Class A properties, but we can get more in rents. Okay, so if that's our business plan, going up to closing, we've already done a lot of the research, right? We've identified where we believe we can get the rents. We've identified how much we believe we're going to need to invest in each unit and the quality of finishes that we're going to need to deliver in order to get that rents, right? So we've established the business plan. So for us, it then goes into the implementation, understanding how do we mitigate risk in a deal, in a project. Some of that's going to be team-based. Some of that's going to be process-driven, right? So how do we communicate amongst ourselves, with our property management team, with our contractors? How do we make sure everyone knows exactly what their job is, what our expectations are, and make sure we stay on track with the project, right? So a lot of these things are project management. I'd love to tell you something that was really cool and creative and fun, but a lot of this is really just like management of any other project. So we're having weekly conversations. We have our trackers. We have our expectations of how many units we believe we can turn in a given month. We're talking to our property management team about, expiring leases. If we can push or release a unit at a higher rent rate without having to turn that, then we'll do that. We want to retain our residents. But if a resident decides, hey, they don't want to pay the new rent, then we can put that down and say, okay, hey, unit, 212 is going to be moving out, February 1st. Let's make sure we've got the crews ready to go, get in there, renovate the unit, have it done, ready, and back on market by, X date. So we kind of have that plan. So a lot of what we do once we take over is really management, right? It's just really managing the team, making sure everybody is clear, make sure everything is set up and the operations are there so things can run swimmingly. The thing we don't want to have happen, and this is not for us, but for any operator, the thing you never want is February 1st comes, such and such moves out, and now you're talking about, hey, we should fix up that unit and renovate it. Like you're behind. You don't have the materials now. you're catching up. You don't want to be in that position. You want to have these things planned in advance so you can work as a machine, just like anything else. You'd want to have it as a machine ready to go. The people knowing exactly what they're doing to that unit. Materials are already ordered, and you can go in and execute.
Yeah. Yeah, it is, and that's how it usually goes. Like a lot of success in life, sort of kind of boring, right? It's not one thing; it's a bunch of things, and and it's. But I think that's important to understand, right? Is that it's, because that's what it is. It's like those sorts of competencies. In this case, like you said, project management. I mean, if it's a core buy and it's stable, right? There's not it's not much you have to do to it. But if it's a value add deal, like you said, and you're trying to your business plan or involves sort of upgrading units and things like that. It's a bunch of moving parts, and it's so if you look at the team, if you're an investor who's assessing an opportunity, I mean, looking at the team who's bringing the deal to market, and none of them sort of have if that competency is nowhere to be found, and there's a bunch of moving parts on, deeper value add play, or even just value add play. I mean, that could be a red flag, right? I mean, it's because that is what it takes to be successful. Is just like you said, it's just management. It's process driven and management and good communication and those sorts of things. So now, with that said, as like a segue. You like you said, you guys partner with some other sponsors like co-GP capacity. So what is your process for deciding whether or not you're willing to participate in that capacity, right? Because I'm assuming that, obviously you guys are negotiating, you have some level of control oversight, but I mean, at the end of the day, it's sort of, they're the, more than likely because it's in their market, they're the operator, right? And they're the one. So how do you assess whether or not, that sort of partnership's worth doing? You know what I mean? Because your guy, because seems to me that, you're putting your reputation at stake, right? And so what is your process for, kind of vetting or, conducting the diligence to decide whether or not you want to do a deal like that with another operator?
Yeah, listen, that's a phenomenal question. And ultimately, there are three components to this question, right? There's the operator or the sponsor themselves, there's the market, and then there's the actual deal. So I start with that order, right? I want to understand the operator, the sponsor. I want to get to know these individuals. First rule of thumb, if I haven't known them at least 6 months, and had conversations about their investing philosophy and understand what it is that they're looking for in deals and opportunities, it's already a no-go. If I met you, 3 weeks ago and you send me a deal and talk about partnership, the answer is no. Yeah. So we need to at least have 6 months, just because I need to see how you show up. Are you consistent? Is the deal that you bring me, is that going to match the criteria or the conversations that we've talked about? I'm not saying it absolutely has to be that, but I'm saying I would want to know any variance to that, right? I want to understand what's changing, how you're operating, the team that you're putting together, not just me, but who's the rest of the team. I'm looking for all the same things that I would look for if I were only investing my own money passively, right? Yeah. So I want to take some time to get to know the person. 6 months is the minimum, by the way. I'm not saying that, hey, once you hit that, let's go. But that's the minimum, and that's knowing you and having conversations about working together. Beyond that, if I don't get the sense that, hey, I would trust this person with my money as an investor, then I'm not going to bring you to our audience by any means. But if I get that sense that, I think this person knows what they're doing, I trust them as an investor, they have a good eye, they have a good team, then we can move on to the deal. But let's kind of come back to the sponsor. Mm-hmm. One of the questions that I like to ask, and I think this is really important for anyone looking to park your money with an investor, is you have to ask them about deals that don't work as well. And the reason for this is simply because everyone loves to talk about their great deals. I mean, I'd love to sit here and just tell you about the deals where I, crushed it and delivered this amazing return for my investors, or how I, my first property, I bought it for X and I made $100,000 and all of this stuff, right? Yeah. That's great and that's fine. But you really want to get at the heart. You want to understand the character. You want to understand, is this person accountable? When you sign up to partner with them and work with them, I'm looking at the character and accountability of the person on the other side. And I'm trying to assess, is this someone who is going to be there and to do the right thing if times go bad, if things go wrong? Will this person do the right thing? So that's one of the main things that I'm assessing. And when I ask that question, what I'm really listening for is how much ownership do they take on whatever happened. I don't care what happened, but I mean, I do, but what I'm really listening for is, does this person take accountability? Did they learn from that? Have they, put in new systems and processes? I mean, no one's going to be perfect, right? No one's going to have every single deal they ever touch to go flawlessly. You may not, I'm not saying you have to lose money or something like that, but every deal is not going to be flawless. Yeah. So I want to understand, when you face hardship, how do you react? Is this someone who's blaming a partner, blaming a property manager, blaming the market? Or is this someone who says, hey, here's what happened. Here's why it happened. Here's what I've learned. Here's how we've adjusted our process and our policies to make sure this doesn't happen again. I'm listening to see if this person is accountable and is learning from those mistakes so that they don't make those mistakes in the future. I'm also listening to see if this person has anything to share, because if they have nothing to share, then that's a good sign that maybe they don't have enough experience, and maybe they're a bit more bullish because they haven't been punched in the face. I think you want to work with somebody who's been punched in the face at least one time, because when you get punched and you lose money in a deal, you learn to take your time when you're evaluating opportunities more. So I'm listening for those kind of things. So as far as people that I want to work with, that's really the first criteria. I ask that question, and that pretty much tells me. I mean, I get the rest of it from my impression of conversations, but that one question can really lean me heavily one way or the other of whether or not it's worth having more conversations about working with someone.
Yeah,
I'll pause there. I know I said the market and the deal, but I'll pause there for a second.
Yeah, no, I think that's a good point, because it is amazing, right? Like how many people are not self-aware enough to even realize that all they do is make excuses for any failure. Right. Like there's just, and that's a quick way to DQ them. Like if they can't, like you said, they can't come up with anything. They're perfect. I've never done anything wrong, never had a bad deal, never had anything. I mean, that's just, there's no way. Right. Like, I mean, once again, if you've been in the game long enough, generally speaking, things probably aren't always going the way you want them to go. So, to kind of get that out of the way and see how they articulate the situation and how they navigated it and those things is, I think that is a great sort of disqualifying question. If anything, it sort of moves you on to okay, you're accountable, you're self-aware enough to know you're not perfect, you're going to make mistakes. That's good. So for you guys, I mean, now that you've been in it, quite some time and have a lot of experience, I mean, what is sort of that number one, like, the best advice you can give to people, or the thing now with 2020 hindsight, what's that thing now that you've learned after being in the game for so long that you sort of lean on when it comes to, investing in multifamily? Like, what is that thing what would you tell your, 25-year-old self? You go back and say, hey, don't, I already know you're going to waste a bunch of time kind of, doing this, that, and the other thing. I'm just going to tell you right now, this is what it's all about. What is that thing?
Yeah. There's two things, right? So the first thing I would say is, hey, be more open to partnerships. You don't have to do it all by yourself, which I think back then I was like, hey, I've got to build my own portfolio. I've got to do it myself. Yeah. People won't take me seriously if I go out and try to partner, and if I don't, have a strong resume that I could bring to the table. I think if I could step back, I would have been more open-minded to recognize that, hey, really what I have to do is add value. And if I'm adding value, then there may be some unique partnership opportunities available. At the time, I had money, I had time, I had energy. So, if you're 25, you're young, you're energetic, figure out what value you bring to the table. It may be capital, it may be resources, it may be, eagerness, whatever it is. Mm-hmm. Figure out what value you bring to the table and look for opportunities that help you move to the next level accordingly. But I wish I would have been more open to it at that time. The other thing that I would say is be really open to passive investment opportunities, because you don't have to be a landlord. You don't have to be the operator to take full advantage of all of the benefits real estate investing has to offer. There's obviously the passive income, there's the diversification of your assets, and there's the beautiful tax benefits, right? Which we all are aware of. But with the bonus depreciation and so many other things, the bottom line is I can make passive money, I can pay less in taxes, and I don't have to do the work. That is a great, formula. The only thing you really need to do is vet opportunities and vet partners so that you can pick the right investments to put your money to work.
Yeah, no, definitely. So what is it that you're sort of seeing out in the market that you kind of shake your head at, like things that maybe you're, kind of the reckless activity? I mean, maybe you're not seeing anything like that, but just the thing that you kind of see and think like, oh my gosh, I can't believe guys are doing this or that.
Well, I mean, we were talking about the three things we look at with evaluating an opportunity, right? So the first one was the operator or the sponsor. The second one is the market. So when it comes to the market, listen, I've seen people make money in every market, right? I mean, we talked about Detroit, but I know a lot of people that make good money in Detroit. So I can't say that, hey, if it's a declining population market or, all the stuff we talked about, if the answer was no to those things, there are people who make money in that, but they're principles. And before you break the rules, you have to understand the rules. So one of the places I see people making a mistake is they're applying things that work in, say, Texas or Florida to other markets that don't have those same dynamics. So you really have to understand that. And I'll give you something very, very specific. Rent growth. When people are looking at their rent growth projections, it really needs to be based on the market. If you're in a market where, things are more stagnant, then your rent growth projections should be brought down. Don't just assume you're going to get a 4 or 5% rent growth because the last couple of years have been really strong. That's not the case necessarily, right? And it goes back to supply and demand. If you're in a market where they're building new apartments, 24/7, at some point that's going to catch up and you're not going to be able to push rents as aggressively, especially if the higher end has to do concessions and pull back. We're seeing that right now with the Bay Area, San Francisco, New York. We're seeing this thing where the rents are actually going down double-digit %. So if you did a deal and you underwrote to a 5% rent growth, you're getting crushed right now because of that, right? So I think you really have to understand the market dynamics and underwrite conservatively based on that. Going back to the third thing is really the deal itself. So when we talk about the deal, it really comes down to the business plan. And I would just say, I mean, I don't know how else to say this, but your business plan should be logical. And you need to really think through the business plan and have someone who can torture test that business plan based on the logic. And, with my corporate background, this is something that we had to do all the time. Like, you can't present something and just expect it to get rubber stamped. I mean, people are going to challenge it when you're talking about spending $100 million on a campaign. I mean, to the word, hey, is action the word we want to use, or is it more about experience? It's like, dude, really? But you're used to getting critiqued. And I think people sometimes take that a little personally. But the reality is that when people are reviewing it, they're going to make it better, right? If you have a lender who's looking at your business plan and they're going to say, hey, you know what, you only have X amount of dollars for this, but we're actually seeing the market norm being this. Okay, now you can either defend your number and justify why you think it's right, or adjust, right? Hey, you know what? Okay, I didn't realize most of the people are seeing this number. Let me go back and reflect that. But I think you have to be open and willing to take that feedback and adjust based on the business plan. And those folks who are, I don't want to say humble, but the people who understand that they're not the end all be all, and that other folks have experience and market knowledge and input and are able to collectively take that information from others, decipher what's the most usable piece of information to make the sound investment or sound decisions. Those are the people that have success. So if you're going back to the personality thing, if you're dealing with somebody who's a know-it-all, run, because they're not going to listen. When you talk about, hey man, I feel like, the market's getting a little tight and stuff I just told you, right? If you're in Dallas, Fort Worth or whatever,
Sure.
and you're like, hey, the market's strong. And this guy's like, a deal junkie, as you mentioned. And they're like, hey, no, everything's good. And you're like, yeah, but what about this concern and this red flag and this? And they're like, no, ignore it. That's where the concern comes into me, right? I'm not saying that they shouldn't have a retort, but I am saying that they should be able to explain that to you based on data and facts and why they don't feel that the concern or question you have is as big of a risk based on the way they're mitigating the deal, right? And that's what I'm looking for, right? Is just, hey, you should be able to defend your projections. And if there's something that, for whatever reason, you can't defend, to have the humility to say, hey, that's a good point. We should probably go back and tweak that projection or that number or that line item. And, we'll come back with that revised. I would have a lot more respect for somebody who was willing to go back and make that adjustment versus somebody who just felt like they need to fall on their sword to get a deal done.
Yeah, exactly. No, that's good stuff. Cool. Well, yeah, this has been great. Touched on a lot of really great stuff. Yeah, I appreciate you taking the time, and that's probably have you on to talk more about markets. I know like I said, I'm just seeing more and more. I know you guys, focus on, you've pivoted away from it, but it's always good to sort of do that assessment. I feel like a lot of people gloss. I mean, they should, but you hit the market sort of thing and just flip through it and, don't pay attention to it. But a lot of what you said today, I mean, it's inherent in it. Like you said, I mean, if you just drop a deal or a pro forma without knowing what market's in or whatever, I mean, it's worthless.
Yeah.
Right.
Lance, let me go further for you too, right? I think people focus on the macro market. We didn't get to talk about this as much. I think the sub market is just as important, if not more important.
Yeah.
Because just being in DFW or being in Detroit, it's not the same. There are pockets of Detroit that are on fire.
Yeah.
There are pockets of DFW that are stagnant, in the metro area.
Yeah.
So yes, you can get lucky and buy something in the region and probably do okay. But do you want to invest off of luck, or do you really want to focus on the fundamentals? And, there's a part of Detroit where there's a city called Royal Oak. There's Royal Oak. There's I forget. There's another little Ferndale, and there's a little sub-market, a pocket that has a great appeal for young millennials. Well, the property values have gone up crazy over the last decade there. And I could have told you that was going to happen because when I lived there, that's where the demand was. There just wasn't enough properties, but that's where all the nightlife is. That's where all the demand is. It's just outside Detroit city limits. So if you understand the sub-market dynamics and you build a business plan based on that renter base, you can have a lot of success, but you have to really understand those dynamics. So it's not just, hey, a lot of people get caught up in the big metro market and not understanding the dynamics of the sub-market, where that property is located, and the associated business plan. Yeah. So I think those are the things that are really, really key when it comes to investing. And like I said, it's like a business plan should make sense. If I ask you 3 or 4 questions about why, it should hold. And if it's just, hey, we're in DFW and we're going to increase rents $200, well, how do you plan on doing that? We're gonna ask for $200 more rent, but you can't justify it anywhere. Yeah. It's like, all right, dude, I feel like you're just making stuff up. But I mean, you should be able to show me, hey, you know, we're gonna start appealing to the residents at this university, or there's a big, employer nearby, whatever it is, right? Just it should make sense. Like someone should be able to tell you this. Yeah. You should be able to see, like, oh, okay, yeah, and they're getting 200 over here. You're gonna do the same finishes. I get it. So some of this is not rocket science, but it does take a while, and you do need to sit and use some critical thinking skills to make sure you understand the story of a property and the story of the business plan. Yeah, no, that's great stuff. Yeah, amazing. Cool. Well, thanks so much, John. It's been great having you on. I appreciate it. And you have a great day. Absolutely. Listen, I'd love to, if anyone wants to follow up on our conversation, I'd love to maybe just share a resource that they can check out. If that's okay with you. Go for it. Yeah. So we have a sample deal on our website. It's more of for active investors, but I think it's great for passive investors too, just to see at least the way we think and the kind of things to look for when you're looking at a package. So if you go to casmoncapital.com/sample deal, that's available on the website. And then you'll get to learn a little bit more about what that looks like and more of our investing philosophy and things like that. But I just think it's really important, at least familiarize yourself with the process and what it looks like, and just take that step forward. If you're looking to use real estate as a way to diversify your income, lower your taxes, and ultimately put yourself in a better position financially, or to protect, your current investments and your current capital, it's a great platform to do that. So just being able to take the next step forward, I think, is really key. And finding great partners, great opportunities to invest in is key. And this is all about networking. So I'd love to connect with anybody who's interested in hearing more, and we can take it from there.
Cool. Sounds good. All right, man. Take care. Thanks so much.
Thank you.
Take care, everyone.
Thank you, Lance.
Yep.